Good morning, everyone. This is Daily Trading Analysis with the market forecast for today, February 23rd. Yesterday, FOMC minutes were released showing that members resolved to keep fighting inflation with rate hikes. While previous minutes have shown that most members were on the same page with the 25 basis points, yesterday's minutes showed that a few of the members believe that 50 basis points rate hike were appropriate during that meeting. And I think that's because even though we've seen inflation coming down, there's also a lot of indicators that are showing sticky inflation. And I think they want to see progress across a broader range of prices. They are looking for that. They want unemployment to go up, and they want PCE to actually show their preferred method of inflation to actually show a decrease. With that said, now that we've seen that Fed mostly has shifted from 50 basis points to 25 basis points, I think there's little indication that they will ramp up again to 50, even though some Feds bullard are proactively asking for 50. I think we are near the terminal rate, and 25 basis points is accurate, is enough to tailor to do these refinements that this situation needs. So PCE is going to be released tomorrow. So until then, today we are looking for GDP, price, growth, and initial jobless claims and continuing jobless claims. But today, I think mostly is going to show this consolidation, this equilibrium and uncertainty about markets, until tomorrow really shows personal income, personal spending, and PCE index. This is going to be huge because it's going to consolidate everything. Last week, core CPI, inflation, retail sales, PPI, and this week's FOMC minutes are going to be consolidating into this number. And tomorrow is going to be key for the future of the markets. Apart from that, for the FOMC minutes, if we check yesterday's price action into the close, we can see that we barely basically moved in a range yesterday between side range activity, price action, bound price action, until the close. And if you notice in the close, there was a super spike to the upside that right now we are holding that spike. This is called late spike, and basically holding above the base of this late spike shows acceptance of higher pricing. And as you can see, we are holding on the Nasdaq this late spike, and on the S&P is not as high as impressive, but Nasdaq is really, really sensitive with these interest rates, and we are actually holding these high prices. So why did this happen? Well, Nvidia reported earnings yesterday, and it was slightly beat revenue and EPS, but I think what most people are focusing right now, the hype train, the FOMO, is on artificial intelligence, AI. And if we check AMD, they were also spiking due to Nvidia, and overall all these chip stocks are focusing on what is called AI right now. And if we check Nvidia earnings, slight beat, but there's still a lot of hype on the AI. They release data center AI chips and also for the new graphic cards. And basically, it's once you continue talking about AI, people lost their minds, and the outlook was moving towards that topic. ChatGPT, AI, Microsoft browsers powered by AI, And I think this is, in my opinion, an overreaction, but this is what caused everything to spike up. This is not something that is driven by fundamentals. And as you can see in the S&Ps, we didn't see this kind of spike. It's mostly related with this AI hype train that everyone is talking about, and due to Nvidia earnings that were a little bit above expectations, but nothing huge. So be careful with the kind of sentiment you have right now, because yesterday we have range bound activity. Today we are more or less holding, but if we check the overall picture on the Nasdaq, yesterday we have this doji, and I think this pivot, well, you already saw yesterday that I'm talking about this pivot, this level that is incredibly important for everyone that is trying to short and also to long this market. What I think is possibly happening is that we just try to go higher, we reject again this zone, these weeks will become resistance, and definitely I can see the markets going down until this kind of weeks at 11,600 more or less. The S&P is also showing that we had this kind of support down here, that previous resistance is now support on, okay, here. So I can see the S&P is also going lower until this, basically 3,900. I don't think we are going to check lows yet, but I can see weakness continuing lower until tomorrow. That's key to understand. I think markets will try to push higher, but will end up range bounding during the day, chopping around as we've seen, because there's no news until tomorrow. Remember, tomorrow is PCE, and we have to focus on that. The rest, pre-market activity, well, Tesla leading, the gap up, everything is in the green, but also yields and dollar are in the green. So be careful, because these kind of divergences definitely play out into the open, setting up traps and trapping a lot of buyers and a lot of sellers, both sides, until you can see clearly the sentiment or the trend. If there's no trend, we may end up being as yesterday with range bound price action. But dollar definitely is focusing on 105, is showing strength, slowly building momentum, and 2-year and 10-year are continuing higher, building green candle after green candle with some kind of pullbacks, but the trend is really, really strong up. Terminal rates, we are still super high, and we have to focus on that. Look at this, 5.36% still showing unbelievably high interest rates this year. And this is something that sooner or later is going to impact the markets heavily. So don't be naive and think about tech stocks are going to be able to hold these levels without hesitation, because with these interest rates, pain is going to happen. It's going to be super painful in the near future. Focus also on sector funds, and most importantly, XLY, consumer discretionary, is super important, and also XLU, XLP, and XLV, defensive sectors that we can see if we check the performance the last couple of days. We can see definitely that they are showing strength. They are showing rotation to the upside. You can see this is the 5 days of sector funds performance. On top of them, XLP, staples, XLU, utilities, healthcare, XLV, XLI, industrials, all these sectors are performing really, really well. And on the bottom, XLE energy and XLK. with consumer discretionary. So this is showing, continuously showing that Wall Street markets are rotating to defensive. To be smart and take this as the edge, as an advantage, to try to understand what kind of things are happening in the market. Regarding China and focusing also again with ChatGPT AIs, what is China doing with all this hype on AI? Well, we know that Microsoft is investing billions of dollars in OpenAI, Google's rush and the catastrophic demo of Bard. Apple is silent, but what China is doing? Well, Baidu, Chinese search engine, is said Wednesday that its AI chatbot will be ready on March. So they are also trying to focus on this hype train. Alibaba is scheduled to release quarterly earnings on Thursday, and also it's internally testing ChatGPT style technology. Tencent with WeChat is testing ChatGPT based intelligence for their precision languages. What else? Kunlun Tech expect to release Chinese version of ChatGPT in the middle of this year. So China is jumping aboard of this hype train. So this topic is going to be huge throughout all this year, but be careful because don't try to focus too much on this and also follow certain fundamentals, because this AI thing is one good thing, one of the best things that are happening in the progression, in the evolution of technology, but don't miss focusing on other things that are important to the markets, the technicals and also the fundamentals with the economic data, like tomorrow's PCE. So be careful when this Microsoft and Google and also Tesla retail pushing this higher are going against the market, when you have things like bonds market and rotation in the sector funds showing you that defensiveness is starting to appear and Wall Street is starting to, I think twice about the kind of move that we are trying to do. So this is the most important thing. This is my opinion. You have to see all markets to try to find convergences and divergences in order to form your bias. But most importantly, just be patient, be disciplined, and have risk management because everything can happen. Yesterday, I took a nice short there, but I covered down here. I didn't greed. I don't want to be greed, but then we got this reversal, and then with the FOMC minutes, another reversal to the bottom, and then the late spike. So these kind of markets are super volatile. VIX is showing this increase in volatility, this jump. We are trying to hold 22, but I can see VIX continuing going higher and increasing volatility on these markets. This is what we are looking for. We want markets to move. So be aware of these kind of moves and have risk management, because you can certainly be destroyed if you don't apply any kind of risk management into your trading. I think that's all from my side. Let me check if I have anything else. Yes, I want to talk about QT. QT, quantitative tightening. It's basically the Fed's, the monetary policy that allow them to sell or to get rid of all the holdings, all the assets that they have. So in summary, during the pandemic, they were doing QE, quantitative easing, that is putting money, buying assets like crazy to support the economy. But at some point, they have to reduce their balance sheet. And that's what they are doing. Since last week, February 15, this is reported on Thursdays. So tomorrow we will have today's reporting. Since last week, they are continuing selling and getting rid of these assets. So the change from prior week is 33. This is thousands of dollars. So 33 billions. They are continuing doing that. Last week, 38 billions. minus 16 billions, minus 20 billions, minus 1. So as you can see, they are reducing their balance sheet. So this thing has, you have to take into consideration that they are selling a lot of assets and putting pressure to the downside because they need to do that. Also, inflation is not cooling overall. Remember that we have sticky inflation, and basically US consumers have been on a shopping spree since 2020, since after the pandemic. Look at this curve. This trend is unsustainable. They were taking their money from the bank, and also based on the money that the government put on the economy during that time, and they spent like crazy. And right now, once that money is out, is done, there's no more money on their accounts. They are going on debt. US credit card balance is crossing 1 trillion. And this is huge because consumer spending is one of the most important things for a healthy economy that goes up. And we are trying to go up, but not on a healthy way. We are not going up with a healthy consumer spending. We are going up on debt, on credit card debt, loans, a lot of payments, also mortgages. When they see that the amount of money that they are taking with credit cards is huge and they have to pay back a lot of money with high interest rates, this is going to be painful for them, for all the families and for all the economy. And sadly, I think that will impact the market and the consumer spending, because there will be no more way of people to keep buying and buying and buying and spending. So this is, I think, this is a bomb that will explode during any time this year, because we are approaching, after all this super spending, we are also reaching incredible levels of credit card debt. So be careful with that, because you have to be aware that all these rallies are based on thinking about that inflation is going down and economy is again asking for consumer spending, and also technology stocks going up. So you have to understand the cycle, and these kind of moves that we are trying to do or to hold are based on a very, very sensitive floor that is called consumer spending, that right now is going to the extremes. People are losing their minds to continue spending, to keep their lifestyle. And at some point, this is going to be broken. This is going to break, and credit card debt will be unsustainable for them, and they will stop spending. And that's when you will see economy and weakness on the markets. So you have to be aware about all this, and because discretionary consumer spending is super important. And again, remember that tomorrow we have PCE and personal income and spending. So look at these kind of things. This will show you if people continues buying and they don't care about inflation. And that's bad. Fed will continue going aggressive, hiking rates and doing their job. So try to understand that, and please focus on these things. Core PCE tomorrow. Be careful with that. As always, thank you for your time. If you have any questions, please comment down below, and I will try to respond to all of you. If you found this video useful, please remember to click the like button and subscribe to the channel to receive notifications when I upload new videos. Remember that I upload new videos every single day for market forecast, market updates, and market recap. I appreciate your time. And remember, discipline and risk management are key for success. Stay safe, everyone, and see you with the market recap later on at noon.